Hey, what's happening, guys? Dan Darrow here with another Options to Play video update. Hope everybody had a fantastic weekend. Uh, we were certainly not lacking for news headlines this morning. One of the busier Mondays of the year, definitely. Had a fair amount of economic, political news with updates on the trade tariff front, right? You had a few M&A stories, and you just had like this overall really great momentum extension push for a lot of tech names, a lot of bios, healthcare. Just it was a strong session Friday, and then they followed up with another strong start this morning, and just a nice opportunity to really cut back on maybe some overextended near-term trades or just some like shorter-term trades that are really seeing great extension. And Acacia, right? That kind of falls into that latter category of just shorter-term trades with really quick, sharp near-term extension. And I wanted to talk about just the trade management style, what I look for, what we've talked about at length quite a few times, right? I haven't done a video on it in a little while, but during our coaching sessions, we go over this quite a bit. And Acacia was just like a really nice example of it. So I felt like it was a good time just to like revisit the idea, just like as a refresher. Um, so I'm sure you guys have been noticing that doing a fair amount of spreads on names into earnings, right? It's just it's one of those things that I like to do. Everybody's got different styles, but I like spreads on things into earnings because it helps you like lower upfront debit, right? So kind of manage your risk a little bit better, especially with some of like the names that are more volatile, pricing in bigger moves, to kind of get risk in line with kind of like the average that we are trying to target for these types of events like earnings or biotech events, what have you, right? The way to do that is to use like spreads or flies, something to basically lower like the net debit, right? So with Acacia, what I liked and really what's been working more recently are these bullish setups in stocks that are kind of like pushing up into like key levels, coming off decent or good numbers, coming off a good quarter, right? We've seen it with like a bunch of different names, different sectors. Acacia was a pretty good example last week because it's coming off like a really nice quarter back in the fall. Had hung in more or less pretty well throughout all of the selling in November, December, right? It did dip, but it snapped back quickly, and then it was just kind of pushing up into like this really key area of resistance, right? You can see like really well-defined area of resistance, like 45, 46 range. So um, basically, what I was looking for was, thinking, A, if they could deliver another solid quarter with the stock decent technical setup, right? And just pushing up into resistance and decent kind of overall action in the market, right? We're kind of just in a strong trend higher. It just seems like there's like a good chance if they could, turn in a good quarter that you could see a pent up breakout, right? Um, so that's why the trade targeted was the near term March 50, 55 call spread, basically with the stock at 45 to 46 area, right? I think actually the day of it was like closer to 47. It ticked up a little bit into the report. But you think like a 10% measured move through like this 45 to 46, 47 resistance area, right, puts you into like the mid 50s, correct? Well, just about 10%, just doing like, like those quick and dirty targets I talk about. So the day reports, right? Nice number, cruises up into like the low 50s, so it hit that first target, right? So that was like the 10% measured move extension target into like the low to mid 50s. So it got there. So that's the point where I thought it made sense to cut risk and roll up, right? So when we're doing that, when I'm rolling up, what I'd like to do is, if possible, and it's not always possible, but I'd like to revert the risk back. So you take off like the open trade and revert risk back to the original debit or lower. So lower if possible, right? And what I also like to do is kind of push the bet out. So meaning like push it out maybe like another couple weeks, or because Acacia in this case only has monthly options available, it was out to the next month, so it was April. Sometimes if they have weeklies, you can just push it out like a couple weeks, which is nice. The ones that have monthlies, pushing it out to like the next month. So it's basically what the idea is you're basically for something that like pops and runs, or drops and runs, whichever way you're leaning, right? And it moves in your favor. What you're trying to do is basically like cut the risk back to the original debit of the trade or less, right? And that kind of returns your risk to like the original level. And then you basically are buying more time and still maintaining some upside exposure, right? So like it was like when the call spread was closed, then it was the April 60 call that was open. So it's basically maintaining upside exposure, pushing the bet out a little bit longer, looking for the secondary move, right? So with 52, so like low to mid 50s, the first target, then that means another 10% extension. So I like to do like I call them quick and dirty targets. So it's 5% extension, 10% extension, 20% extension, etc. So 10% was into like the low to mid 50s, 20% into like the high 50s. So this morning, with everything kind of extending, like I was talking about, you had the secondary move up into the mid 50s, and that's the point where I felt like it made sense to take the remainder of the trade off. It doesn't always work as fast, and it doesn't always work exactly the same way. So like for instance, if the stock had come back, right, then the further out of the money call is going to lose value. But that's why you're cutting back risk, right? So you're taking premium off the table and reverting back below the original risk. And this is just really like a very option oriented way to like manage trades, right? This is not something you could really do with equities, right? So we talk about this all the time. Like if you, for instance, only had like 100 shares, you can't close out of 100 shares and still maintain 100 shares of upside exposure, right? I mean, the only way to do that would be you have to like close out shares underneath it. And for options, you can close out. Say you have one contract, you can close it out and then roll up to another contract, so you're still maintaining that like same exposure. So it'd be like the equivalent of 100 shares, except you're locking in premium and then you're rolling up. So kind of just reducing your risk back to the original amount. So this is something we talk about. It's super important just because trade management is really like the difference between how you get successful at this job over like a long period, right? It's when things work in your favor. It's like what are your techniques of taking money off, of exiting. Also when things don't work in your favor, right? So trade management is important because it's how you manage your winners, how you manage your losers. So that's why it's always good to talk about. So I'd love to hear what you guys think. What do you guys think of the trade? What do you guys thought of the trade? And then just what do you think of like the trade management style in general? So please reach out. Okay, so pretty busy week. Just in terms of what's scheduled, started off with a pretty busy morning today. So I was expecting Monday to be a little bit slower, but it ended up being a little bit busier in terms of news. So just really setting up for a really jam-packed week of headlines in general. So lots to look forward to this week. Lots of pretty interesting earnings. So keep an eye out for those trade ideas. I hope you guys have a great night. And I'll talk to you guys tomorrow.